What is the strategy for yield farming with crypto lending? Imagine turning your digital assets into a steady stream of income while helping others access liquidity. That's what yield farming with crypto lending is all about. It's a way to earn passive income by lending your cryptocurrencies on different platforms. Whether you choose a centralized exchange or a decentralized protocol, the goal is to maximize your returns while managing risks. In simple terms, yield farming involves providing your crypto assets to protocols that use them for trading, loans, or liquidity pools. When you lend your assets, you earn interest, fees, or even governance tokens. Centralized exchanges handle lending by pooling user deposits and lending to borrowers, offering fixed or variable interest rates. These platforms are easier to use, regulated, and have straightforward interfaces. They often have options like limit and market orders for trading, which can help you manage your assets better. Decentralized platforms use smart contracts to automate lending and borrowing. You supply your assets to liquidity pools, and borrowers put up collateral to draw funds. Interest rates are set by algorithms based on supply and demand. These protocols often reward lenders with governance tokens, which you can stake or sell to boost your earnings. Fees are an important part of the picture. Centralized platforms might charge withdrawal fees, borrowing fees, or platform commissions, which can cut into your profits. Decentralized platforms have gas fees, which are transaction costs on the blockchain, and sometimes protocol fees taken from your interest or rewards. It's essential to consider these costs when planning your yield farming strategy. Order types in centralized exchanges like limit or market orders help you trade assets efficiently, indirectly influencing your lending position. In DeFi, there are no traditional order books. Instead, you interact with liquidity pools directly, and prices are set by smart contract formulas. This means your focus is on providing liquidity or borrowing via these pools rather than placing specific orders. The main strategy involves choosing assets wisely. Lending stablecoins like US dollars or US dollars equivalents can give you steady interest with lower risk. Providing liquidity to DeFi pools can earn you interest plus governance tokens, which can increase your total yield. Some investors use leverage by borrowing assets against collateral to lend more or participate in liquidity pools, boosting returns but also increasing risk. Looping strategies, where you repeatedly borrow and relend assets, can maximize exposure and earnings. You can also look for pools that offer multiple incentives, like base interest, trading fees, and token rewards. Using auto-compounding vaults or aggregators can automatically reinvest your earned rewards, helping your investments grow faster through compound interest. To reduce risks like impermanent loss, many prefer pools with stablecoins or protocols that have built-in protections. Managing risks is key. Be aware of smart contract vulnerabilities, which could lead to losses if bugs or exploits occur. Keep an eye on liquidation risks if you use leverage or looping strategies, and consider market volatility that can affect liquidity pools. Always check the reputation of the platform, its fee structure, and whether it complies with regulations. In the end, your strategy for yield farming with crypto lending depends on your risk appetite, the platforms you choose, and how actively you manage your assets. Picking the right assets, understanding the costs, and balancing potential rewards with risks can help you grow your crypto holdings effectively.